These are all areas of reporting accounts that you can go to that can either give you some red flags or some nice surprises where you think, actually, there's quite a lot of hidden value within this company.
I think other things that people can look for is things like, is the story changing? You need to be reasonably eagle-eyed and to have followed a company for a few periods or years to be able to spot this. But if you're sort of getting to know a company and suddenly they're talking about a different strategy, that could be a red flag. And the other one is, I have to say, the phrase, we've just made a strategic acquisition, which often, not always, but often means we really wanted this business and we didn't care what we paid for it.
Hello and welcome to Investing for the Long Term with Judith, Mackenzie and Rosemary Banyard. Judith is partner and head of Downing Fund Managers, and Rosemary is an award-winning fund manager who manages the VT Downing Unique Opportunities Fund. This is the third episode of a 6-part series where each episode builds on the next and becomes part of a mini-series of an investor's journey. During this episode, Judith and Rosemary share what they look for in a good company, how they analyse company accounts, views on managements, AGMs, moats, and perhaps just as important, what are the red flags to avoid. If you enjoy listening to this episode and would like to hear more from Judith and Rosemary, then please let us know by leaving a comment, subscribing and sharing with your networks. That way we can keep more great content coming your way. Now, just before we get started, please remember that all opinions and information are for educational purposes and do not constitute investment advice. Investing carries a high level of risk and is not right for everyone. Always do your own research and seek financial advice from a regulated financial advisor in your country before making any financial decisions. With that being said, let's get started. Hello, Judith. Hello, Rosemary.
Hi, Lee. How are you doing?
Hi, Lee.
I thought we'd start right at the beginning. We've got a universe of under 2,000 stocks here in the UK and multiple thousands internationally. Where do each of you start when you're looking at that universe of multiple thousands? Where do you guys start to potentially drill it down to create your watch list then?
It will depend on your mandate. If you're one of us and you've got a fund, it will set out where you're going to invest. And for me, I only invest in the UK market, and that's because that's the market I know. I'm comfortable that I understand the accounts. I'm comfortable that I understand the stock exchange rules. And I guess it's my home market, so it's the right sort of currency. But I also am very conscious that the vast majority of UK companies actually have activities all around the world. So even though I'm investing in the UK, I am actually gaining an interest overseas through these businesses. So for me in the UK, and I'm talking about my fund now, I do a cut-off at 100 million market cap. So I won't look below that. I leave that to Judith and others with expertise in microcaps. I also have a cut-off because the fund I run is open-ended, and so people can put money in or take money out literally any day. And so you have to be quite careful not to get trapped in things that are illiquid, and you might then find you were a forced seller of something that you didn't want to be because somebody took the money out. To avoid that risk, I don't invest below 100 million, but that doesn't mean that individual investors couldn't or shouldn't do that. I think that cuts out roughly half of the companies that I could invest in the UK. There's an awful lot of small ones. So that gets it down to a few hundred. And then I have certain sectors actually that I don't tend to invest in. And they are sectors where I've either had bad experiences in the past and have lost money, or sectors where I don't feel I have expertise, or where I don't think that there is a durable competitive advantage. And for me, I don't invest in companies whose main activity is mining or oil exploration and production because I am not an expert in that area and I can't forecast the price of minerals. And I also don't invest in loss makers, and I don't invest in certain other sort of smaller areas such as restaurants or actually gambling. So you can whittle it down just by eliminating things you're not comfortable with.
We'll let Judith share her philosophy, but then we'll find out how you then go from a few hundred down to your actual a handful of companies.
I think I echo quite a lot of what Rosemary has said. I would put it very basically and say that we don't invest in things that we don't understand within 5 minutes. So we're not looking out for a complexity of a business model. It really is trying to be able to map and understand them. So that can eliminate quite a good number. And it comes back to that sector point as well. I don't invest in holes in the ground. We don't do minerals and extraction, again, probably because we're not geologists and we don't understand them. So as simple as that, really. I think there's another two aspects. If you ask a few fund managers, they would probably say that they use screening tools. And that's a nice way to say that you get a big funnel of 2,000 companies and then whittle them down. I think it's flawed in a number of ways when it comes to smaller companies. So as Rosemary says, we're typically investing in companies under 500 million market cap, but the real kind of sweet spot is that kind of 150 to 200, 250 or so. You can do as much as you like in terms of a Bloomberg screen or a FactSet screen, which sometimes people perceive as being a barrier because it's a bit of technology that you can use. It might be a barrier for somebody coming into investing. I actually think that it's an advantage not to have a funnel or a screening tool because, especially in smaller companies, you don't get the integrity of the information that you can get when it's a FTSE company. So the go-to place is always the report accounts for me. I might play around with a screen that might screen for free cash flow, return on invested capital, looking at historic EPS growth, balance sheet, market cap, etc., profitability. But really, it's a very blunt tool, and it's something I might do on a Friday afternoon just to see if I've missed anything. But the first place I go to after that is the report and accounts, because these big companies like Bloomberg and FactSet, they don't update the data that well for smaller companies. It's not something that they do very well. So there's that screening aspect that then, if we're looking at only profitable companies that we can understand, where they've probably got a superior return on invested capital for their sector, then that can, again, push you down to that 300 to 400 companies. The other bit that I think is quite important is knowledge. We've been around the block. And I'm not saying that we know all of those 2,000 companies, which we don't, but we probably know a good number that are in our universe of 300 companies or so. And through the years, you probably met most of the profitable ones. So even just in the morning at 7, switching on the screen and going through the RNSs of what's announced that day, you're not going through every single company, but you're getting a really good flavour and quite a good mechanism to almost do your own screening through that stock market information. And that's accessible to everybody, just like report accounts are. And then I think the last bit, I would say that sometimes if I am looking for new ideas, I might think about some sectors that might be attracting some good contracts, maybe where you're seeing that there are contracts being awarded to the energy sector. I'm not talking about energy per se, but maybe companies associated with it, whether it be service providers or whatever, then maybe start doing a little bit of research into that sector. So you're building on not just what you're seeing in the market on a sort of daily basis, but also your knowledge about different sectors. So there's no one simple way to actually arrive at that lower list of 300 to 400 companies to start screening properly. It really is a combination of all of them.
The other thing, Judith, and I think you're with me on this, is that I like to avoid companies which have got too much debt. That's perhaps wasn't an issue for many people through the last 20 years when we had really quite unusually low interest rates. But now that interest rates have normalised and the banks are making sure that the businesses they lend to have got the ability to pay higher rates, and withdrawing capital in some instances, it's ever more important. And so I prefer to have companies with no debt, but I will allow a modest amount. But it's surprising if there's a downturn, how quickly that can get out of control. So I have to be careful on that one.
Yeah, it's probably easier to see all the things that we don't invest in. And I think that's quite good to have basic rules where you know that you're not comfortable, whether it be sector or industry or debt. I know we'll come on and talk about management teams as well in the future too, but knowing what your red flags are and what your tolerance level is quite useful.
We're definitely going to touch on red flags a little bit later in the conversation. You mentioned there, Judith, you check the RNSs. For those perhaps maybe are new to this podcast series, would you mind just sharing what an RNS is and why do you check them?
So it stands for Regulatory News Service. I actually had to think about that. So basically, when a company puts news out, it does it through the Regulatory News Service of the London Stock Exchange. So it means that everybody's got the same information on that company. So we're as equal as anybody else as an investor. And they tend to come out at 7 a.m. before the market starts opening around about 8ish. And it really gives you a snapshot on what's happening that day and the companies in the stock market. So you've got some ready information at your hands at that point. And they tend to have headlines. It could be anything from transaction in own shares, so maybe a company that's buying back shares, right the way through to interim reports and accounts or full year reports or new directors So you can actually just look at the headlines, and some are just business as usual type headlines, but others are maybe a bit more significant. New contract wins, for example. So it really gives you a good snapshot. You're not reading every single one of them, but you're really just looking for something that might catch your attention in companies that you might have met before or you've had a little bit of interest in. And it gives you that ready information that you can then just start adding to your own kind of database and data bank, on going back to that knowledge aspect and maybe some of the keys when it comes to screening and the financial metrics. For instance, if there's a contract win, is it improved margins or is it going to improve the return on invested capital? That kind of dynamic. So it's quite a good live update on how the market's looking.
Brilliant that. Thank you for sharing, Judith. So how do you go from a universe of a few hundred companies down to your watch list of just a handful of stocks?
Yeah, so as Judith said, although we might use screens to screen for certain financial metrics, we don't do it slavishly because the screens that you can access are not always representing everything that you want to know. And there may be companies that don't appear on the screen that you're interested in. So speaking for my fund, I am looking then for companies with good returns on equity, capital employed, invested capital. They're all manifestations of the same thing. So I'm looking for companies that are making a good profit out of the capital that they've got in the business. I'm also interested in companies with superior profit margins. And so I'd be wanting to invest in companies where the profit margins are preferably over 10%. That's the operating margin. Clearly, there are other people out there who are, let's call them recovery funds or turnaround funds, who might not worry about that. They might actually be more interested in a company with a very low margin because they think it can be improved. Different people will do different things, but I'm looking for very profitable businesses on the whole. I would say don't have massive amounts of capital intensive activities, and they're therefore making good levels of profit on the money that they've invested. I guess I'm looking for those kinds of dynamics. And the thing is, as Judith implied, over time, you build up a knowledge base of a lot of companies. And also, because I prepare models, over time, you've got more and more models in your bank. And the knowledge base is constantly improving.
I echo quite a lot of that. Again, probably look at free cash as a go-to, and that kind of ties into that balance sheet structure. So free cash that, I mean, sometimes it's interesting to get a company that had got a little bit of debt and it's generating free cash and it's paying down debt. That can sometimes be quite interesting at that point. But it really comes back to that free cash flow aspect. It's got to be able to generate free cash. And then if it's able to do that and it's got a good return on invested capital, it means it's going to take that cash and spend that pound back in the business. And it's got a 20% return on invested capital, then you're going to get 20% on top of that pound. So that's lovely. It's the art of compounding added in, isn't it? So that gives you the kind of reassurance. I suppose maybe just looking at how we're doing that goes back to the accounts again, goes back to what the company is seeing, and really like to go back as far as you can. And when you get 10 or 20 years even sometimes of companies' accounts, that's great because you can see how consistent that cash flow is through more difficult times. And you can see how the management teams gauge themselves, what their KPIs are. And very often it's quite interesting to see management teams that maybe 5 years ago had different KPIs to what they have now. So if you see a change in that KPI, then you wonder actually if they've managed to miss it and therefore they want to change it. The exciting bit for me is being able to map the journey of the company through 10, 15, 20 years sometimes, and going right back to maybe the prospectus when they first came to the market. And that tells you a lot. Again, it can give you quite a few red flags as you go through it too. So yeah, the reporting accounts for me is just absolute go-to place.
I think these days, report and accounts, although they're irritating to companies because they're so much fatter, a certain amount of repetition, which could be eliminated. But there's more information in there, actually just beyond the numbers. So I would always recommend someone who's thinking about investing to read the latest accounts for the company, and you will learn a lot. You will learn about their strategy, you'll learn about the management, you'll learn about the different businesses, if they've got several divisions, you'll learn a lot. And these days also, you get reports on the various committees of the board and what they've been talking about in the past year, what their main subjects of interest to them have been, and including what the main board's topics have been. And you may think, oh gosh, that sounds a bit dry, but sometimes if you just prepared to read through it, you'll end up with a very good picture of the things they have front of mind for them. And occasionally you get a gem. So about 4 years ago, I was reading through a set of accounts for a company called Chemring. which is a defence business. And in the section talking about what the board had been up to, it said that they had been reviewing their takeover defences. I can tell you this is extremely unusual to read in a set of accounts, and it made me sit up and rather chimed with the fact that they perhaps felt a little bit vulnerable at that point, that they were a good business and undervalued, and they were clearly worried that somebody might come along and bid for them on the cheap. And this has clearly been a topic that they'd been addressing. You don't often see that one, but that was a real encouragement to invest if ever I'd seen one.
That's a good one, actually, isn't it? Yeah, and also you can find out what they get paid. So that's obviously quite a motivating factor for management teams in a positive and a negative way, whether it comes to their base salaries. Are they getting really high base salaries and bonuses? Have they got modest salaries and bonuses, and have they invested in shares themselves throughout the year? We'd quite like to see that. That's the skin in the game point, isn't it? So if a management team is investing in the shares at the same time as we are, then that feels quite good. But if they're sitting there with no equity themselves and taking big salaries and bonuses and getting free equity from long-term incentive plans, then that's a bit of a no as well. It's almost impossible actually to summarise where to go and look for or look at in the accounts. But I quite like starting at the back because it's got the notes to the accounts there. Then that can actually tie you back into what they're saying at the front. And you can almost test if what they're saying in the narrative is true to what the numbers tell you.
On the question of pay for directors, Charlie Munger famously said, "Show me the incentive and I'll show you the outcome," which is absolutely dead right. So if someone has quite a lot of shares in the business and is running it, they're highly likely to be running it for the benefit of shareholders, of which we also are among them. But if a management team has very little by way of shareholding and gets some for free, as Judith said, and then regularly sells those, and so it stays in a position where they hardly own anything, you have to ask the question, what exactly are they incentivized on? And if it's something like adjusted earnings per share, which adjusts out all the bad news and benefits from, say, lots of acquisitions, you shouldn't be surprised if you see the management team of that company doing everything they can to boost adjusted earnings per share. But that might not be in our interests as shareholders. So incentives absolutely vital.
Does it matter how the business makes money? What I mean by that is what its USP is, or whether it has a moat, or does it matter whether it's selling widgets or selling software? How important is that?
Probably goes back to the moat question, doesn't it? What the USP is. And if they've got a moat, then they can charge more for what they're doing, very basically. So if it's a commodity type company that's selling the same widget as the company next door to it, then it's probably less likely to be able to charge a premium price for it. And I think that's one thing that Rosemary talks about very well when she's writing about her fund, is that moat really is so important, because if you don't have it, you're going to succumb to competition. You're not going to be able to maintain your margins, and therefore your return on equity is probably going to be lower. So it really is about that moat.
Yes, a lot has been written on the subject of moats. This is a term that was first coined by Warren Buffett a long time ago now, and he talked about wanting to invest in a heavily fortified castle with a large, wide moat with piranhas in the moat. And it's quite a picture. And yes, a lot of people have spent a lot of time thinking about what the barriers or the moats could be to keep out competition. But for me, they fall in certain categories. One is, has the business got patent, although we have to recognise that those do have a finite life? Does it have regulatory permissions or licenses it needs to operate? So there's a broad category there. Another category might be a unique asset. Another category might be very low cost manufacturing, although you have to be careful with that one because, of course, somewhere that's low cost this decade might not be so next decade. Another category is now much better understood in our times is network effect. So if we think about businesses that operate really over the internet, usually, or not necessarily actually, but it could be a physical one, but they have a network. If you're in that virtuous circle where the more customers you get, the more suppliers you get, and then you get more customers and then you get more suppliers, and you're into that circle, it can be very powerful. I would be thinking here about somebody like Rightmove, because they've just announced they're trading well. And if you think about that, they have the vast majority of people searching for a house in the UK will look at Rightmove. And then because so many people look at Rightmove, an awful lot of estate agents want to have their properties put on Rightmove, and the estate agents are the people that are paying them. And so you get into that virtuous circle. So that's often an interesting kind of business. And then another one, which I see quite commonly, is businesses where it's really difficult or expensive to switch. The easiest example is something like Microsoft, where people are using their software. And, if there was even something free, there probably are free equivalents of Word or Excel out there, but most of us won't switch because everything we've got is linked into that. For us, all our models are in Excel. So the costs of switching are just so horrific that you just wouldn't, unless you'd have to have an incredibly compelling reason. So those businesses are quite resilient to competition. Not so sure about brands. They're often cited as keeping competition out, but I think in some consumer brands, it's quite hard these days because you've got supermarket own label, which is obviously much cheaper and often as good, sometimes in blind tastings better. This sort of area is tougher. So where you've got a brand, but it's very easily substitutable, I think one needs to be a little bit careful.
We've covered a lot there on narrowing it down to a group of companies of high potentials, on your watch list. What about red flags? What sort of things, when you're going through all this process, does then eliminate these companies?
I think there's maybe some just basics, and I'm not going to list all of them, but there's a few that you can maybe put in your back pocket. Just going back to the accounts, you maybe go to the back pages. The company has to make disclosures on related party transactions. And sometimes that can show you that the chief exec is renting out a property to the company, and you've got to make sure that is proportionate. That's just one example. So it's basically where somebody on the board has got a personal financial interest in some of the activities of the company. So that can sometimes be a bit of a red flag. Revenue recognition, that's a whole topic all on its own when it comes to how companies, or what time companies recognize the revenue. There are quite strict accounting rules as to how a company is guided as to when they book revenue. And there's lots of examples, sadly, in the past where that's been manipulated a little bit. It's really trying to figure out that when a contract comes in, it's not just getting booked straight to revenue. It's actually some of it needs to be delivered first. So understanding what the revenue recognition policy is quite good. Then if they've got hard assets, it's quite good to look to see if they have revalued those assets, whether it be a property or whatever. Some companies are really prudent and won't have revalued them for 20 years. And we know that properties have typically gone up in the last 20 years. So you can maybe make a judgment call on whether you think that the assets that the company owns, the properties that they own, might be undervalued. So that's quite nice to find out as well. And then there's what we call the capitalization policies. So that's when a business is investing in some software or development, then they are allowed to capitalize it, which means that the charge goes to the balance sheet and not through the profit and loss account. And that can sometimes flatter what's on the profit and loss account, which for me is why we look so much at free cash, because that is a true number, not necessarily an accounting number. So understanding what that capitalization policy is quite interesting. It also gives you a good idea as to whether the business needs to keep investing in its software or development every year. So say it might be making 4 million of profits on paper. It might have to invest 3 million a year to keep the developers and everything else going. So that's quite important for us as well. Yeah, do they always have to keep investing to really just to keep the lights on? And then, of course, that margin point that Rosemary has already talked about quite a bit. So these are all areas of the reporting accounts that you can go to that can either give you some red flags or some nice surprises where you think, actually, there's quite a lot of hidden value within this company. It's a very efficient business that doesn't have to keep heavily investing. It's quite an asset-light business where you get a good return on invested capital. And it therefore is hopefully going to be generating free cash flow.
I think other things that people can look for is things like, is the story changing? You need to be reasonably eagle-eyed and to have followed a company for a few periods or years to be able to spot this. But if you're sort of getting to know a company and suddenly they're talking about a different strategy, that could be a red flag. And the other one is, I have to say, that the phrase, we've just made a strategic acquisition, which often, not always, but often means we really wanted this business and we didn't care what we paid for it.
Yeah, we've seen a few of those over the last few years, haven't we? Yeah,
have.
it's or when sometimes they buy a company and when they're telling you about the price that they have bought it for, they discount it by what they call the synergies, what they think they can maybe take out of the business. To be honest, I don't really care because you can't bet on synergies. Sometimes these synergies never come through and you only ever find out with the benefit of hindsight. All we really want to care about is what they paid for the business.
It's the most detailed podcast episode I think I've done on actually analysing a company. I mean, essentially what you've shared so far is a blueprint for analysing companies. I think what I've realised as well is that there's a lot of work that goes into this. And sometimes it's probably easier just to get the experts like yourselves to do it on people's behalf. That I think visiting Downing fund managers sometimes is an easier step than trying to learn all this yourself. But one thing I'm curious is, how has this changed over the years? You've been doing it multiple decades. Is it still the same, or has it got easier? Has it got harder? Has technology helped?
Yeah, I mean, I think the technology's definitely changed, but I don't know if that changed. That's not really changed my approach at all, actually. We used to get these books out. You might remember them, Rosemary. I think they were, was it Refs? It was called, and basically a big book that would come in every month that would summarize all the companies in the stock market and churn out ratios and whatever. But really, it was just a summary of what you could get in the report and accounts and do yourself. And I guess Bloomberg and the expensive systems that drive some fund managers now are really just a glorified refs that are on screen and with some data analytic tools. As we've talked about already, I think one of our USPs is that we go back to the source of the truth because it's the only place that you can really get that. And that is what the company publishes in the report and accounts. So everything that's layered on top of that over the last 10 years, 20 years is just a bit of a shortcut. I don't think it's changed the way I've necessarily invested over the last 20 years. Is that true, do you think, Rosemary?
I think so. As I say, I've alluded to, there's probably more in reports and accounts now than there was, but not all of it is incremental. Some of it is in terms of
Yeah.
the written stuff. I think that more companies are now becoming more available to individual potential investors through podcasts and through the internet. And I think on the whole, that is helpful for people because you can now tune into one of these organizations that will, allow a company to present their results, and you can listen in on capital markets days. You've obviously got to remember that they are somewhat in promotional mode when companies do this, with that caveat, but in a way that you wouldn't have been able to in the past unless you pitched up to their annual general meeting in person. You can actually see management, hear management, and sometimes hear the questions of other investors and the answers, which can be helpful. I think technology is helping access, but I think I totally agree with Judith that the basics are still as they ever were. And there is this fundamental point, I think, that the value of a business is ultimately the sum of its future cash flows discounted to the present day at whatever discount rate you consider appropriate. And that is, and always has been, the ultimate way to value a company. So nothing's changed in that regard.
Yeah, so in summary, it's essentially speeded up the availability of information and probably accessibility, but the fundamental principles are still as they were. You mentioned earlier in the episode, AGMs, how high do they rank on your analysis techniques when you're looking at companies?
So this is the annual general meeting, which companies hold annually, once a year, to which all shareholders can attend. These days, because most people own their shares through some sort of platform, you will probably have to get a letter of accreditation from the platform in order to attend, but it's, my experience, pretty straightforward. So I think that AGMs are useful. I can't say that I go to that many due to busyness, but I'm always glad when I do. And the merits are the whole board of directors are there. And so if you want to talk to the chairman or the head of the remuneration committee or any of the board, they're there. So you can raise questions if you want in the formal meeting. Sometimes they will do a presentation and showcase a little bit of what they've been up to. And it really depends from one to another how they handle that. But yes, you would learn a lot. The one that I most regularly attend and have done for years and years is Games Workshop, the fantasy warrior tabletop business. One of the reasons was it's the sort of thing where you go there and you get a sense just in the buildings of the culture of the company. So they've got a huge room in their Nottingham headquarters where enthusiastic gamers come. It's open to the public and you get people sitting at tables playing one another, and they've got a museum and a shop. Because it's a sort of fantasy world, you can, when you go there, you can also see in the lobby there's a flagstone floor and chairs that look a bit as though they've come out of a medieval castle. You get the sense that this is a company that really lives and breathes its culture. They also, from time to time, have done visits around the AGM where you can go and see different parts of their factory, whether it's warehouse or paint making or model making. So, it can be that some of them are more interesting than others and worthwhile.
Yeah, I think I'd echo that too. It's quite telling if a company, given that they're open door showcase once a year, if they plan the AGM for 9 o'clock on a Monday morning and somewhere that's impossible to get to by public transport, it tells you that they're not interested in their shareholders. So that's a good thing to look out for as well. I don't go to all of them, but I do regret not going to more because very often you get to meet private shareholders. So these might be investors that maybe have only got a few £1,000 or a few £100 in the company, but they tend to have a really good view on life and the company itself. So it's hearing some of the questions that they ask and just being able to chat to them as well as to what they think about the company. Aside from what Rosemary was saying, those are the two aspects that I look out for when I'm looking at AGMs and maybe thinking about attending.
So many different nuances, like you say there, just noticing the day and the time that they book it on. Monday, 9 o'clock in the morning, red flag, potentially. If you are new and you're listening to this and you're not sure what some of these terms mean, we can't go into all the details, can we, in a 45-minute episode? Free cash flow, return on capital, invested capital, just Google them. Go on Google now, type them in, and there'll be plenty of information to help explain some of those terms. But in terms of a process, in terms of a start to finish, I think you've delivered massive value there, guys. Is there anything else before we come to the last question, which is a couple of books to share? Anything else that you think we may have missed or you'd like to share?
We've talked about some of our approaches, but I'm learning every day still. So it's not that you get to a stage and you think, okay, that's the tools that I have in the toolbox and I've learned how to read accounts. I learned something from every set of accounts that I ever pick up. So yeah, I would just read what you can and start building on your knowledge. And there's some really good books out there as well. I quite like reading about financial fraud because it tells you where some of the obvious things, with the benefit of hindsight, where it's frauds like Enron or Madoff or whatever. And there's quite a good book called Financial Shenanigans. I think it's been around for about 20 odd years, if not longer. I think it's Howard Schultz that wrote it, and it's now on its 4th edition. I suppose it teaches you that there's nothing really new in the world when it comes to accounting and fraud and whatever. It tends to be the same thing in different guises. But that's quite an interesting read because it does refer back to a number of events in the past where you can see some trends.
Have you just shared your one book?
I'm not
to
reading
read
that
then
at the
for
moment.
Financial Shenanigans?
No, I haven't. I'm not. I dip in and dip out of it. It's not the easiest read. It's probably quite good to put headphones on and if you go out for a long walk or something. It's not necessarily a bedside read.
Rosemary, any final thoughts before we share what book you're reading?
I think I go back to emphasize the importance of management. We've talked about when they have skin in the game, they're more likely to be aligned with other shareholders' interests, not always, but it's more likely. And I think whether you're going to an AGM or looking at a podcast or a presentation, that just trying to gauge management is important, that they can explain the business in ways that you can understand easily. Or are they just using jargon? Do you sense that there's a team there, preferably one with longevity, actually, rather than revolving door syndrome? It's impossible to know if they're trustworthy in some sense, but do you think they're the sort of people you'd want to work for? I think that's quite important.
It makes sense. If you're investing in that company, they kind of almost are working for you, aren't they? They're going to be hopefully compounding that investment upwards. So those types of things is going to be important. So as we come to the end, one book that you're currently reading at the moment. Who wants to go first? Judith?
A bit of a real life thriller. It's called The Red Notice by Bill Browder.
Oh, yes.
Browder, even. You like it? Have you read it?
I have.
No, I didn't realise there was a series made out of it, so I'm a bit disappointed. Yeah, there was a series made last year, so I'm now going to have to go to Netflix and download it. This is a story about a true story about a fund manager in Russia, and in the 1990s, I think. Quite an interesting personal story, but his parents were absolute socialists, and he wanted to get his own back at his father, and so he wanted to become a capitalist and tried to figure out how to do that. And in doing that, he was at university and then stumbled across what was, I suppose, the Wild West in those days, and that was the privatizations of Russian companies. And a lot of the businesses were being sold to Russian mafia at really low prices. So he wanted to basically be part of that. And he did that by going and getting set up in Moscow as an investor. And he was a bit of a vigilante because he was trying to cry out, and I quite like this because I like being an activist investor as well. He was trying to cry out against the mafia for bad behavior and governance. But that tends to only go in one direction. As you can tell by his book, sadly was a murder, and I think he was lucky to get out with his life. And he's written this story that really is quite captivating. It tells the story of a country going through an immense amount of turmoil and change, and the very worst of capitalism at work. So yeah, I quite like that one. But Rosemary, you've obviously read it as well by the sounds of it.
Yeah, I've read it, and it's horrifying in some regards, isn't it? What happened? I think it was the lawyer, wasn't it, that got murdered because he couldn't leave Russia.
Yeah, he just couldn't get out.
Yeah.
That's just made it to my reading list after your reaction.
Or go and watch it on Netflix now.
Oh, it's on Netflix. Wow, that's easier.
I just saw last night that there was a series out. I didn't even know it was there. I was just reading the book.
What about you, Rosemary?
Yeah, that's a good suggestion, Judith. I was going to suggest something. I can't honestly say I'm reading it right now, but I recommend it. If we're thinking about AGMs and attending them, I suspect that the best attended AGM in this country is the one for Terry Smith's fund. So the fund Smith, and I think he gets 1,000 or more people along.
Yeah.
So Terry started life as a banking analyst, and I came across him then, and he eventually became fund manager, launched some funds, and he's a very plain speaking guy, and he also writes in a very clear way, and so is a common sense, easy to understand. When he was an analyst, he wrote a book called Accounting for Growth, which is about an era sort of 30 years old, but he got into difficulties because he was criticizing some of the accounting practices of those times, got in difficulties with some of the companies. 3 years ago, he then published a book called Investing for Growth. That's the book I would recommend. It's couched somewhat as shareholder letters over the previous 10 years, but even if that sounds dry, it's actually a good read. And the subtitle is How to Make Money by Only Buying the Best Companies in the World. So he's a global investor. He invests in companies like Visa or L'Oreal on the cosmetics front. So he's just a thought-provoking individual, and it's easy to read.
Well, that's it for today. In our next episode, Judith and Rosemary will focus on investor psychology, investing through recessions, and the skills required to invest for the long term. To learn more about Rosemary, Judith, and Downing, please visit www.downingfundmanagers.co.uk. All the links are just below in the show notes. And if you like what you heard, please subscribe and leave a comment. The more feedback we get, the more value we can offer. Thanks for listening. We look forward to speaking to you in our next episode. Hope you have a great day, and bye for now.